The investment landscape has changed markedly over the period of the first half of 2016. Yes, some indices are at record highs, such as the S&P 500. Meanwhile, the FTSE 250, the mid-cap index here in the UK, remains well below record highs of 2012 and has a negative return for the year to date. But one area that is receiving most interest is precious metals. Old Mutual Global Investors has recently launched a fund to benefit from this area, and Ned Naylor-Leyland is the fund manager who joins us now. Ned, welcome.
Thank you very much.
Talking here, it's all about timing, I guess. First of all, let's take a look at the overview and why one should now be interested in this sort of area. I've highlighted a little bit of what's going on underneath, but how are you coming at this investment landscape?
Sure. Well, I think that the key thing to understand about gold and silver, they trade in sympathy with each other, is that really they're cash alternatives. In fact, one might argue, as Greenspan once said, that gold is even better than the dollar. It's the sort of the counterparty risk-free form of cash. Now, on that basis, there's an opportunity cost at play in financial markets when looking at gold and silver. So when some people might say gold has no yield, well, in an environment where cash and near cash instruments are certainly on a real basis in terms of netting inflation away, are substantially negative in terms of yield, then gold and silver starts to look very attractive. And indeed, that negative real yield environment drove gold up to 2011. The expectation of rate hikes drove it down over 3.5 years as markets expected a positive return on cash and near cash. And now suddenly I think markets have worked out again that's not coming. And as a result, gold and silver then suddenly look very, very interesting. But I mean, for me, the real point is that there isn't anything else you can own as an investor in the modern economy, which is a genuine hedge against this very unconventional environment that we're in.
Well, let's take a look at that. Yes, why should one fly in the face of all this money coming in from central bankers? We've got potential easing here in the UK. We've already seen a lot of easing in the Eurozone. They're already pumping a lot of money in there. We've got £250 billion, I believe, the Bank of England is sitting on ready to allocate to the markets. Surely this is an opportunity to go into other areas of the market. Well,
look, that may or may not be the case, Jeremy. I don't want to comment on other sectors, but what I will say is that those other sectors are pretty much pricing in a benign outcome to very unconventional monetary policy. I mean, you could argue that the phrase unconventional monetary policy is a pretty generous one. Really, we're in very strange times. And actually, even historically, if you look at a portfolio on a back-tested basis, you should own 2 to 5% in gold bullion as a diversifier. I mean, there are various academic studies that show that that's around the right number. But that doesn't include systemic risk, genuine monetary system risk, which I think is very apparent now. I don't think anybody can genuinely argue the toss on that. It is a highly unconventional environment. So I would tend to say, look at your net worth pie chart and then consider yourself, what part of that do I want as an absolutely direct hedge or insurance policy against this not working out well?
So where are we along the scale of, should we be defensive within this sector of gold and silver, neutral or bullish? Whereabouts along the scale are we, do you think, at the moment?
You would imagine I would say this to you, but I would say I think I've never seen it quite so ripe for investment right now. There are several reasons, but the most important confluence is a massive change in momentum this year, driven by a change in the real yield environment, but also sentiment-wise, we're just seeing sentiment start to go. In other words, it hasn't actually caught up with the momentum in terms of what the market's doing. Sentiment's just turning, you can feel it, and you can see it. There are various indicators you can look at. But I think the combination of improved sentiment and momentum at the same time, while the mining shares are now making real, genuine margin in a way that they weren't. 2009, 2011 looked like a good period for gold investing, but the input costs of the mining companies were soaring at the time, whether it was energy or labour or domestic FX. All of these things were going up commensurately with the gold and silver price, and that's not the case now. So I think that there's a kind of almost a perfect storm for investing in the sector.
How is your fund structured at the moment? Because I think you've got exposure to bullion as well as stocks within the global sphere. Let's take a look at how your fund is structured.
Sure. So we take the view that if you're investing in gold, like I touched on earlier, you should be doing it out of the need for systemic insurance, really. Therefore, we try to de-risk to a degree what we do while retaining plenty of upside. And so we own physical, and we own physical in the form of what are called bullion funds, which are listed investment trusts in US and Canada. And we have 17% of the portfolio in those at the moment.
So that's exposure to the price of gold and silver.
To physical gold and silver. And the reason for that is because people generally do like to own both. They want to own the real stuff, but they also like the geared upside of the miners. And what we generally tend to say is that by owning silver equities, you've got a lot more torque built into your portfolio, and you don't need to own gold juniors or have a very long tail in the portfolio. So basically we have a blend of physical and mid-cap gold and silver mining stocks generally in production.
Okay, in terms of if the situation eases off, how does that mix change?
Well, look, if the conditions for investing in the space, and I would reiterate what I said earlier, which would require a rising real yield environment, so it would require central bankers to deliver a series of rate hikes, and I see that as being rather fanciful at the moment. But should that condition come about and our triggers in our process tell us we need to be more defensive, then we would go up to 50% in physical and back off from the allocation to the mining stocks.
Okay, what sort of mining stocks are you talking about here? Just give us a few ideas of some of your top allocated miners at the moment.
Well, look, there are some interesting names in London in silver. Our thesis is that the mega cap gold equities have been through a process of reserve dilution over a period of 15 years. They've not been replacing the reserves they've been mining. As a result, they're going to reach a cliff at some point in the next 5 odd years. And I think that it looks very likely they're going to have to buy the companies that sit a bit lower down them in the pyramid, as it were. So we for that reason, because we think there's unpriced optionality in these mid-cap and second-tier producers, focus on that part of the market. So it's one step down from the mega caps, down to, let's say, market caps of around $1 billion. That's the sort of scale of mining company that we look to invest in.
What about the spread of options there within the stocks themselves? Because you've got explorers as well as producers. Do you go for the explorers? Do you go for those that are just entering the market in a certain area?
Look, we don't rule them out completely, and indeed I think we have 2.5% of the portfolio in what you might call explorers. The ones that we own are in very safe geopolitical jurisdictions, and they're quite advanced in terms of their development. But generally, I feel that in a fund it's very difficult to invest in those stocks because you can't really get out. Unless a bigger company comes in and buys the underlying company, you don't really have a liquidity event, so you'll see some good profits on paper. But I would tend to say those kind of instruments are probably better for individuals to have a speculation with as opposed to funds like ours.
What about the price of silver and gold? What are your thoughts?
Well, look, I think that in light of where we are on a macro level, I absolutely expect the all-time highs to go, and I don't know when it will be. It could be next year, it could be a bit longer, or it could be in some great firestorm monetary event. But I'm not one big one for picking a number because I'm very much of the view that fiat money is denominated in gold rather than the other way around. Bear in mind that, of course, Bretton Woods was established with gold still at the centre of the monetary system, and I think that's where we'll return to. Yeah,
it's all about timing, as you said.
Of course.
Takes us back to the start of the interview. Ned, thanks indeed for joining us. Ned Naylor-Leyland is the fund manager of the new gold and silver fund at Old Mutual Global Investors.